Welcome to this explainer. Have you ever stared at a stock chart and thought, what on earth am I looking at? I mean, is there any actual rhyme or reason to all those chaotic zigzags, or is it just random noise? Well, if you've ever wondered that, you are in the exact right place. Today, we are going to decode those jagged lines and uncover the invisible forces that are actually driving market prices. We're taking a fascinating look at the very foundation of technical analysis.
So can drawing imaginary lines on a stock chart genuinely help you beat the market? Let's dive right into that question by exploring the core concepts that day traders and massive institutional investors rely on every single day. We're going to see if historical price data, volume, and market trends can actually predict where a price is heading next. It sounds a little bit like magic, I know, but as you'll see, it is deeply rooted in how markets, and more importantly, the humans trading in them, actually behave.
Let's kick things off with Section 1, the floor and ceiling. To really grasp how price barriers work, you have to visualize the market as a continuous tug-of-war between supply and demand. Every single tick on a chart, that's a live negotiation. It's buyers and sellers trying to figure out what an asset is worth right now. So the crucial takeaway here is that support acts as a price floor. That's where buyers eagerly step in to scoop up a deal. Resistance, on the other hand, is your ceiling. That's where sellers take over because they think the asset is getting way too expensive. Think about it. During a downtrend, prices are falling because everybody is selling. But eventually, the price drops so low that it looks like a total steal to traders waiting on the sidelines. Demand skyrockets to match supply, and the price just stops falling. Bam! That is your support floor. Conversely, as prices rise, they hit a point where traders want to take their profits. The selling completely overwhelms the buying, and that creates your resistance ceiling. And look, these levels aren't just pulled out of thin air. They're actually rooted in something called the Dow theory. This was developed way back in the late 19th century by Charles H. Dow. Essentially, the theory assumes that all the news, all the panic, all the relevant information out there is already baked right into the market prices. So financial markets naturally move in trends. You have primary trends that can last for years, secondary pullbacks, and your minor daily fluctuations. The big idea here? The trend is your friend. A previous trend will likely just keep on going until we see clear physical signs of a reversal, like a price actually breaking right through one of those support or resistance levels. Moving on to Section 2, Psychology of Price Barriers. This is where things transition from pure math into the wild world of human behavioral finance. Let's be real, unlike the perfectly rational robots in economic textbooks, actual human traders are emotional. We make cognitive errors. We rely on mental shortcuts all the time. One of the biggest errors is a cognitive bias called anchoring. We tend to attach immense value to certain price levels just because they feel significant to us. You know that feeling when you're holding onto a losing stock, just praying it gets back to the exact price you originally paid for it so you can break even? Yeah, that's anchoring in action. An old resistance level can literally become an anchor in a trader's mind. Even if the underlying company has changed entirely, that old price point sticks in their head, dictating when they decide to buy or sell. And this brings us to our absolute obsession with nice, round numbers. Our brains easily process numbers like $50 or $100. Because of that, massive clusters of buy and sell orders tend to pile up at these exact round numbers, which physically creates a resistance ceiling on a chart. It becomes a complete self-fulfilling prophecy. Research actually backs this up, showing that Wall Street analysts' target prices and traders' stop-loss orders heavily cluster right at these round numbers. Think about it. If every client at a major investment bank puts in a sell order at exactly $55, it takes an absolute mountain of buying pressure to absorb all those sales and finally break through that ceiling. So how do you know if a price barrier is actually strong? Well, there are a few telltale signs that turn this into actionable intelligence. First, a barrier is significantly stronger if it has been tested multiple times. The more a price hits a level and bounces off, the more the market notices it. Second, look for levels that follow a really steep, fast price move. Third, and this is huge, check the trading volume. If a level was established on massive volume, traders remember the pain of their losses or the thrill of their gains at those exact price points, making them fiercely defend those levels later on. And finally, time frame matters. A support level built over a few months on a weekly chart is vastly more significant than one built over a 5-minute window.
Let's jump into Section 3, Spotting Levels on a Chart.
Now that we understand the why behind these invisible barriers, what tools do analysts use to actually spot them in the wild? Well, simple horizontal lines are great, but financial assets usually trend up or down over time, right? That's where trend lines come in. Traders use trend lines to track that upward or downward momentum. The golden rule here is waiting for the price to touch that line at least 3 times to confirm it's actually a valid dynamic barrier. In an uptrend, you draw the line below the price. When the price pulls back a little bit, maybe people are just taking some quick profits, it drops down toward that line. Since that line historically stopped the price from dropping further, traders watch it like a hawk, waiting for the bounce. In a downtrend, it's the exact opposite. You draw the line above the price, connecting the declining peaks to map out a downward-sloping ceiling. Now, if manually drawing trend lines isn't your thing, you can use moving averages. These are incredibly popular because they automatically smooth out past price data to identify dynamic support and resistance levels. A 50-day moving average, for example, will trail right behind the price action. You'll routinely see a stock's price fall, touch that moving average line, and bounce right back up as if it hit a physical, concrete floor. And get this, traders even use math found in nature. Ever heard of the golden ratio? 1.62. Yes, the exact same mathematical sequence found in sunflower seeds and ancient architecture is used by traders. Tools like Fibonacci retracements use these ratios to map out potential hidden support and resistance levels. And because so many short-term traders are staring at these exact natural numbers, it again becomes a self-fulfilling prophecy, creating formidable, invisible barriers. Which brings us to Section 4, when support becomes resistance. What happens when the floor finally caves in or the ceiling shatters? This is where market dynamics get truly fascinating, because these levels don't just vanish into thin air, they transform. When a floor is broken, the abrupt shift in market sentiment turns that exact same price point into a brand new resistance ceiling. Let me paint a picture for you. Imagine you're holding a stock, trusting a really strong support level. Suddenly, massive selling pressure absolutely shatters that floor. The sentiment instantly shifts. Traders holding long positions totally panic and sell to get out, while new traders jump in to short the stock. Now, when the price inevitably tries to creep back up to where that old floor was, all those burned traders sell just to break even, and the short sellers pile on to defend their positions. Just like that, your old floor's support has become an iron ceiling of resistance. Finally, Section 5. Does this actually work? You might be sitting there thinking, come on, this all sounds like astrology for finance bros. I get it. Is this just humans seeing shapes in the clouds, or is there a measurable advantage here? Well, let's look at some hard empirical data. A massive 5-year academic study running from mid-2018 to mid-2023 analyzed these exact strategies across 6 major financial markets. And the researchers didn't just casually glance at a few charts. They used rigorous probability algorithms and Sharpe ratio models to genuinely test if a breakout strategy based on support and resistance could actually hold its own today. The results are pretty incredible. The data explicitly proved that actively trading based on support and resistance in the JSE and DAX markets actually enhanced portfolio value over a simple passive buy and hold approach. In those specific international markets, meticulously tracking the psychological barriers, drawing the trend lines, and watching the volume actually gave market participants a mathematical edge over investors who just bought an asset and closed their eyes. So how would you actually execute this validated strategy yourself? The playbook is surprisingly straightforward. First, you set your entry point slightly above the identified support level. That slightly above part is absolutely crucial because it confirms the price is actually rebounding rather than just plummeting straight through the floor. Next, you plan to sell near the resistance ceiling. Finally, and listen closely, you must always use a stop-loss order to manage your risk. Technical analysis isn't a flawless crystal ball. Sometimes the floor breaks. The stop-loss ensures that when a reversal happens, your portfolio doesn't get trapped in a freefall. It adds that critical layer of discipline. As we wrap up this explainer, I want to leave you with a final thought to chew on before you place your next trade. We've seen that the jagged lines on a chart aren't just random noise. They are a visual, real-time map of human psychology, supply, demand, and cognitive bias. They form invisible barriers that the data shows can absolutely be leveraged to enhance a portfolio. The market is constantly leaving clues out there for those who actually know how to read them. So, the next time you invest, are you going to keep trading in the dark, or are you ready to start drawing some lines?